Ladies and gentlemen, good day and welcome to the CleanMax Q4 and FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kuldeep Jain, Founder and Managing Director at CleanMax, for his opening remarks. Thank you, and over to you, sir.
Thank you. Hi, everyone. This is Kuldeep here. Should we just wait a little while to see if we have all, a quorum of participants and then we join? I don't know where we can monitor the number of people, or if the operator can give us any guidance, and then we can start when most people are in. So I think we have 77 participants who have joined. So we will begin. And, the format is we've just announced our results yesterday. I'm Kuldeep. I'm the founder and chairman and managing director of CleanMax. This is Nikunj, our CFO. And we will run through a presentation. I'll take the first business section. Nikunj will take some financial highlights. And then we will pause for Q&A. Right, that's the format. So this is that. I'll get going with the presentation. So highlights for FY26. So we're trying to cover more first the highlights for the full financial year, which we will go through right now. So CleanMax is India's largest C&I renewable energy provider. A few highlights of the year, operational highlights of the year for you. First is as of 1st April 2026, at the end of last fiscal, we have 5.7 gigawatt or 5,700 of contracted renewable energy sales capacity. So we've contracted, have signed PPAs for 5,700 megawatt as of the end of the fiscal. As of the end of the fiscal, we have 3.1 gigawatt operational out of this. And therefore, 2.6 gigawatt is contracted, but in the process of being executed. And in the last fiscal, which is financial year 25-26, we have added new capacity of about 1,400 megawatts. Right? So that's the new capacity addition that we have had in the last fiscal. Now, operational highlights on financial highlights for the year. Our EBITDA is 1,295 crores, up about, I think, 28% from 1,015 crores for last fiscal. Another dimension is leverage cost, which is important in our business. It's reduced due to efforts of Nikunj and team from 9.2% to about 8.5%. Our consolidated profit after tax, PAT, has grown from about 19% in fiscal 24-25 to 86 crores. Sorry, 19 crores in 24-25 to 86 crores in 25-26. And these are receivable days remains broadly the same at about 25-26 days. Some other financial highlights, but now concentrating more on the quarter. We had a 350 crore rupee EBITDA number. And 32% EBITDA CAGR over the last 3 years. Again, the consolidated PAT was 45 crores versus 17 crores in the last quarter of last year. And, 3-year revenue CAGR is about 26%. A couple of other business highlights is, one is our 42% of our contracted capacity is with data and AI. So out of the 5,700 megawatt of capacity that we have, about 42% is for data and AI customers. To give you, as investors or potential investors, a sense of transition, 2 years ago, i.e. on 1st April 2024, this number was about 14%. So in 2 years, it's grown from 14% to 42%. But our overall business has grown. And as a result, in megawatt terms, this has grown nearly 10 times from about 240 megawatt to 2,400 megawatt. So 240 megawatt of data and AI contracted capacity in April 2024 has risen to about 2,400 megawatt as of April 2026. So 2 years, 10x for data and AI. And the other metric which we consistently monitor is that we continue to have nearly 3/4, so 74% of new volumes that we contracted this past year was with existing clients. So it's sort of our repeat business rate, and it has for many years been consistently in that 75% type mark. So, a lot of satisfied clients, data and AI being big part of our growth. So that is one broad thing. Some more details. One is we added 1,400 megawatt of capacity. What this page gives you is where this capacity was added, sort of in which state and so on. And therefore, it starts with April 2025, start of the fiscal, shows the capacity we added in each year, and looks at the end, March 2026, and therefore, the split there. And one thing I would like to highlight is, if you look at where we are, we have an extremely diversified set of growth engines in terms of the number of states in which we are doing this business. In addition to state-specific, what we call STU-connected plants, which supply green power to corporates, we also have what you see as point number 6, which is CTU-connected projects, which is 17% of capacity, but I think about 12-13% of our run rate EBITDA, which supply big tech companies with IREC type solutions. And we have on-site solar, which is about 13% of capacity, and I think maybe slightly more of our run rate EBITDA. So, we have a very, very diversified pool of growth engines, and a number of clients is the message I would like to highlight. The other thing to highlight here is at the start of the year, we had about 1,700 megawatt. At start of last fiscal, we had 1,700 megawatt of operational capacity. So it took us whatever 10, 12 years to get to this number. And in 1 year, which is the same year when we did an IPO, we added about 1,400 megawatt of capacity, ending the financial year at about 3,100 megawatt of operational capacity in the RE sales, power sales segment. The full book that we show is in the following way. We have two business segments, as you're all aware. One is renewable energy power sales, where we have long-term power purchase agreements. There, the operational capacity is about 3,100 megawatt, as we see here. We saw on the last page the spread. Then there's contracted and yet to be executed capacity of another 2,600 megawatt. Right, and the first two numbers are really where those numbers were over the last 2 years, to give you all a sense of the growth and its trajectory. And therefore, the total RE power sales business is 5.7 gigawatt of contracted capacity, right, as of 31st March 2026. The second thing is we have an RE services business. This is really where we build plants for customers who want to own the assets on their books, and then typically have a lifetime of revenues from maintaining, servicing, and allowing them to avail of our common infrastructure and power transmission. This was operational capacity of 555 megawatt, but a lot of under construction, another 215 megawatt is under construction in this segment. And therefore, if you add both of these segments, the total portfolio is about 6.5 gigawatt. If you want to focus only on the RE power sales, which is the PPA contracted sales, is 5.7 gigawatt. Then some other financial result highlights. One is revenues have sort of grown by about 28%, both on a fiscal and almost similar number on a quarter basis. Our EBITDA has again grown by a similar 28%, from about 1,015 crores to about 1,295 crores. And the margins, we have two business segments with very different margin profiles, but we are glad to report that margins have improved in both of our business segments. So business segment number one is renewable energy power sales, where we sell power under long-term PPA. There, the EBITDA margins have improved from about 82% last fiscal to 83.5% in FY25-26. Right? This is predominantly due to operating leverage. As capacities grow, the operating expenses or SG&A does not grow at the same pace. So the gross margin remains similar, but you have an improvement in EBITDA margin. The second business line is RE services, which has grown from about 14.4% EBITDA margin to about 19.6% EBITDA margin. So both business segments have seen a good growth in the EBITDA margin and a 28% growth in revenues overall, translating into a 28% also growth in EBITDA as well. And the reported PAT has then seen a massive leap of about 4.4 times, from slightly below 20 crores for fiscal 25 to slightly in excess of 85 crores in fiscal 26. So that has been the growth in the reported PAT as well. The other metric we always point to in our business is run rate EBITDA. Let me explain what is run rate EBITDA. Run rate EBITDA means as of that point in the financials, in this case, 31st March 2026, what is the run rate of the plants already commissioned if they operated for the full year, right? So that run rate EBITDA number is about 1,870 crore rupees, right? This grew from a starting point run rate EBITDA of about 1,140 crore rupees in, as of 1st April 2025. Now, as a rule, we do not as a company give a EBITDA forecast or guidance for next year, right? But what we have historically seen is that the reported EBITDA is about 1.1 times the run rate EBITDA. As you can see, the reported EBITDA here was 11,015 crores, which is about 1.1 times 950 crores, and the reported EBITDA here is 1295 crores, which is again 1.1 times 1140 crores run rate EBITDA, right? So that's the way it happens, which is at the start of the financial year, whatever is the run rate EBITDA, you should make that much, maybe slightly more, right? That's how the thing works. But again, it's not a forecast. We're just telling you what has happened in the past. So our run rate EBITDA at the start of the current fiscal, again, is 1,870 crores, right? So that's the number we have right here. Now, there are a few things which we pointed out as what could be the positives or negatives around whether this run rate EBITDA translates fully into the reported EBITDA or not, right? What are the, if you will, the upsides and downsides to it? So there are 3 points which we wanted to explain about our business. So first is post any COD, like you achieve the commissioning or you're ready to begin operations, it takes about 3 to 6 months for revenue stabilization. This happens due to various factors: technical plant stabilization, some documentation may happen, some regulatory final approval may take time. There may be a ramp-up phase. So all of that is one thing. Second is we have a 525 megawatt CTU project in Rajasthan. This is about 12% of our run rate EBITDA. And Rajasthan CTU projects, as you're all aware, have been facing some grid back down. So there is some risk in full realization of this to the extent of the back down. But in terms of quantifying that risk, it applies to about 12% of our run rate EBITDA. Right? So if the back down is, the grid believes that back down will continue for another 6 months, and if it is, say, 40%, then the risk is on 12% of our EBITDA for 6 months, so that's 6% and 40% of that, so that's around 2.5% of EBITDA. If it continues for the whole year and back down is 50%, then the risk is 6%. So, that's how we would think about it and quantify. The last point is that, however, there are assets which we have, so we keep adding assets, so that would be a sort of upside to it. Right. So that's the basis of these numbers. Now, the other thing we wanted to highlight is that, look, we have a huge diversity in terms of our growth levers, and we'll show you how our pie chart has shifted. Often I get questions from potential investors about concentration of risk in different states or different clients and so on. And we always like to highlight that we are both very diversified, and if you see the movement over a period of time, you will realize that the level of diversity of this risk has only improved. So, we have various types of projects. We have STU projects. We've broken them up into the state of Karnataka STU projects, state of Gujarat, and others. There are CTU projects, there are on-site rooftop solar projects. So if you look at 1st April 2023, Karnataka, this is again 3 years ago, was a lion's share about 60%, and on-site solar was 30%. So you could say 10% is everything else. This is as of 3 years ago. Then if you see the very next year, Gujarat became a bigger share, became about 36%, Karnataka was 43%, and on-site solar was 17%. But again, this keeps diversifying over time. If you look at the start of last fiscal, this is how that pie chart looked. And if we look at it now, 1st April 2026, the other states put together is now quite chunky. It's about 14% for the other states, and this share will keep growing as we have a lot more capacity coming up in these states. In addition, we've got CTU as a growth segment now. As you can see here, it's about 12 or 13% of our run rate EBITDA, and therefore it's looking more and more diversified. Now, within each of these states, these are not contracts with government off-takers. Each of these states has a lot of diversification within it. As an example, if you looked at Karnataka, which is now 33% of our run rate EBITDA, in Karnataka alone, I would draw your attention to the footnote, which is this is spread across 6 sites, 55 customers, with 71% of the capacity in solar and 29% in wind. Right? So it's extremely diversified across sites which are physical generating locations. That is important because if you have unitary risk, all your production is in one site, anything happens to the site, or there's backdown, or there's any technical issues, then you have an issue. Here we are across 6 sites. Second is customer diversification is important. Our average PPA is about 12 to 13 megawatts. So, we have 55 customers. And wind and solar diversification is also important. So you will see last year we had slightly lesser generation from solar, but a lot more generation in wind. This year, people are talking about the El Nino weather effect. El Nino typically corresponds with lower wind output, right? But you'll have less rainfall, less wind, so you'll have more solar output. So that diversification is important as well. And that's only in one state. And then we have so many states. So I want to highlight that in our business model, we have a lot of diversification, which is great from a risk perspective. It also means we have a lot of growth engines. So we have a diversified pool of growth engines and a diversified away risk framework. Then we have some key unit economics provided. I will not touch upon these, but we went through these in our last analyst presentation as well. One thing to highlight, we consistently operate at very profitable levels in terms of our investment economics. If you look at our tariff for 2,600 megawatt, which is contracted and under execution, right? 2,600 megawatt contracted and under execution, which will come up in fiscal 26, 27, and 27, 28. These are contracted at an average tariff of about 3.85 rupees per unit of power. And this is about 70% solar, 30% wind, and not much battery storage within it. Very, very minuscule amounts of battery storage. So I would say this is fully, no storage is one way to put it. 3.85 is the average tariff of portfolio with for growth in the next 2 years for portfolio with 70% solar and 30% wind. Right? So that is what I would highlight in terms of economics. And I will request Nikunj now to present the next few pages. This afternoon.
You can do that.
Okay. So, sorry, I've just been instructed. I have to present these, so I'll continue. So okay, we'll come to a few more business updates. Again, here we want to talk about the fact that data and AI, we've seen tremendous growth. It's 42% of our total contracted capacity, up from 14% 2 years ago. And as a result, it's grown from about 240 megawatt to 2,400 megawatt. A lot of deals have happened in the last 1 year in data and AI space, but we are delighted to have got first few, have got an inroad or one account into Princeton Digital Group and Iron Mountain, which are very important and growing players in the data center space. And we're delighted to be able to publicly report that we have a lot of repeat deals with customers like STT Data as well. In addition, in terms of what is conventional industries, which is really everyone else consuming power, we've contracted a lot of volumes and, done it across industries and sectors. But yeah, big players to talk about are in cement and auto components, tire manufacturing, chemicals, and so on. So our contracting run rate is very strong. So as of the start of this fiscal, we have 2,600 megawatt contracted yet to be executed. Last year we built 1.4 gigawatt. We also fully replenished that pipeline by having 1.4 gigawatt of contracts. The guidance we are giving, we don't give guidances on financial numbers for next fiscal, but our guidance on new capacity addition is that we will have at least 1,500 megawatt or 1.5 gigawatt of RE power sales capacity addition in financial year 26-27. Right? And we are very confident of being able to achieve these numbers. A few other operating parameters around that. One is repeat business rate continues to be very high, about 75% of new volume. So if we say we contracted 1.4 gigawatt, 3/4 of that, 75% is with existing customers. We continue to serve the biggest and best corporates. From day one of founding, this has been our core purpose and something which has caused us to do very, very well, which is CleanMax serves the biggest and best companies. 82% of our volumes are with clients who are credit rated AA, AAA or multinationals. Another 14% is with A-rated, and therefore 96% with credit rated A and above, and 82% is AA, AAA MNCs. And the numbers on the top and bottom half are correlated, because if you do a great job of serving the biggest and best customers, they are the ones who are growing and have a lot of facilities, so you get a lot of new opportunity to add capacity with them. A few other numbers. Our PPA tenure remains very robust. We have about 23 years is our average PPA tenure. It is no less than the utility players, but it is at a very profitable tariff. Without storage, it is 3.85. Again, as I said, for a mix which is 70% solar and 30% wind. We have 588 customers, and we are consistently adding more states in which we are doing renewable energy power sales. We are currently dispatching power in more than 7 states, and I think this year we are looking forward to add a number of new states. We currently have under construction in states like Rajasthan and Andhra Pradesh and Uttarakhand. So, we are adding new states to this mix. The other aspect in our business is execution discipline. This is very, very core in our kind of business. So first is in terms of growth. If you look at the total capacity we added across both RE power sales as well as RE services segment, we added about 1,471 megawatt of new capacity compared to less than 500 in the last year. So in our IPO year, we grew the amount of capacity being commissioned by 3x. The other thing is, if you're building plants, are you able to build them in time and within budgets? Right? We are very proud that over the last 4 years, consistently, we have executed our plants and capacities within the budgets, and that's the tip of the iceberg kind of metric, because you can't have that if you did not have robust project development in terms of land and permitting, if you did not have good project management, if you did not have good supply chain management, good financial discipline, if you did not take care of your ROW and transmission issues in time. So all of this factors in to deliver a robust sort of achieved cost to budgeted number. And I would like to highlight that it's a multi-year thing. It's not just a one-time aspect. The third thing is we have a grid uptime. One of the factors people talk about is what is the grid uptime that you are facing, because particularly for plants in CTUs, there is a lot of issues with backdowns and curtailment risk. So our achieved grid uptime continues to be well in excess of 99%. So therefore, it indicates almost a no curtailment scenario, because 99.25 is really the remainder 0.75% is not even curtailment, it's really the expected downtime or maintenance time that grids also need for their lines and substations. And this is largely because ours is fully into STUs. So last year we had no curtailment. As I said in my commentary earlier, yes, 12 to 13% of our run rate EBITDA is CTU project, which has just commissioned. And for that project, to that extent, we expect to see some more curtailment. But curtailment is a very CTU issue and really not an STU issue, as evidenced by these numbers. Then if you look at the PLF of our plants, last financial year was a great year in terms of wind power generation. So we saw wind PLF rise from 32% to 35%. But the solar offsite PLF, I think this is hidden by decimal points, but it's slightly lower because radiation was slightly lesser. So technically, both our wind and solar plants continue to do very well in terms of uptime and technical performance. But yes, in terms of resource availability, last year was a good year for wind, slightly less of a good year for solar, and that reflects in the PLF now. There was a press announcement last week which we put out. These are some snippets from that, of our joint venture with Apple. Under that joint venture, CleanMax owns 51% and Apple India Private Limited owns 49%. Apple is investing 104 crores of equity for a 49% equity stake in 150 megawatt of projects. These are three different projects. They actually do not supply the power to Apple, but these are their financial investments in projects with us. And this is our second joint venture with Apple. We had one which was announced in 2024, and this builds upon that. So this is just one other announcement I want to make. I'll hand over to Nikunj to take us through the financial results.
Thank you, Kuldeep. We have the quarterly and yearly numbers here, Q4 and full year. I think the revenue and PAT and EBITDA Kuldeep already touched upon. The only point I'd like to highlight here is that both segments, which is RE Power Cells and RE Services, continues to do well, and both have seen the 30%, 28 to 30% kind of a growth. And primarily on the balance sheet numbers, the gross block and capital work in progress reflect the capacity addition which we have done and are also doing, and the net debt number of 9,600 crores approximately for the end of the year is broadly in line with what the capacity addition is, and then broadly in the metrics of the net debt to EBITDA which we track. And total equity does reflect now the IPO proceeds. So there are the key messages on this slide. The specifics are covered earlier, so I'll rather move to the next slide. Revenue from operation, both segment, if you see the power sales and the we have two segments, which is RE Power Cells and the RE Services. We've seen the growth in both the segment and the margin expansion. If I draw your attention to the margin comparison for RE Power Cells and the RE Services, the gross margin profile for RE power sales remains consistent at around 92 to 93%, but there is a EBITDA margin expansion there because of the operating leverage with the scale of operation. And RE services business, we had a very healthy year last year compared to previous year, and both gross margin and the EBITDA margin expanded. What is other parameters beyond margin which we should spend some time on is the cash flow profile of the business and the leverage against it. So there's one metric which we very carefully monitor is that how the cash flow and the net debts are building up. And here is the waterfall which we see, wherein the cash flow or in our business, when the assets get stabilized, which typically takes 9 months to 12 months, then the debt against it becomes fully self-sustaining. So that's why this metric of what are the projects operational for more than a year and what is the EBITDA generated, which is a proxy of the cash flow against those projects. And that is around, if you look at that number on the left-hand side, which is the dark green bar, is around 4.3x net debt to EBITDA. And that is well below our target of 5 to 5.5 range. So once the assets stabilize, they become fully self-sustaining. And of course, we added a lot of capacities last year. So there was an additional net debt which gets added, but those assets are still just recently got commissioned or still under construction. So that's very important to understand in terms of the buildup of the cash flows and the net debt. And that's what we try to provide, which would not just visible on the face of the balance sheet. The other, and this is for our RE power sales segment, because 90% of the EBITDA comes from the RE power sales, which is more run rate and an annuity business. Here, what we're trying to explain is that there is a consistent increase into the EBITDA margin, though the gross margin remains flat at around 93%, because it's a very high gross margin business that's very stable and predictable, 92 to 93% gross margin, which is visible over FY23, 25, 26 or 4 years. But the increase in EBITDA is merely the SG&A compressing as a percentage of total income from 18% to 9%, which is what the operating leverage now getting reflected on the EBITDA. And we believe that we are now reaching to the critical mass. It's not that we will continue to just reduce the SG&A at the same pace, but happy to see that the numbers are reaching to the more the critical mass level. The other important aspect of our business is a high capital intensive business, and we have to take leverage for our growth and to fund our capital expenditure. And that is why the cost of financing is a very important metric for us to track, look at, and see what we should do on a consistent basis to keep it on a reducing trend or keep it very much in line. In last 3 years, we've been able to consistently reduce it from 9.4 to 8.5%. This primarily because of the mix of refinancing of the portfolios once they get matured, and then able to bring down the cost of financing on that. Also, a strategy of moving on a regular basis some debt to the fixed debt or a fixed rate debt, which then not subjected to significant interest rate risk. So, for example, as on March 2026, 40% of our portfolio is fixed rate financing, and that remains constant. So once we refinance, we try to do that. That helps. And then other thing is that is the leverage profile self-sustaining? So the DSCR, which is the debt service coverage ratio, it was 1.3x for the FY26 for the project which are stabilized and been operating for more than 12 months. And also the asset liability management, that if PPA's tenure is 23 years, we always ensure that the weighted average loan is less than that. So isn't it the weighted average loan profile is 19 years, and the cash flow contracted is more than that. That also gives the visibility on the regular servicing. And of course, the net debt to EBITDA and the credit rating profile of the company, that is another 2 parameters we consistently track and monitor.
So we'll stop here in terms of our presentations to you all. And we are on for questions now. Thank you.
Thank you very much.
Operator, if you can just open it for, yeah.
Certainly, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to please use handsets while asking a question. Ladies and gentlemen, we will now wait for a moment while the question queue assembles. Our first question is a text question from Vineet Jain from Vodafone. What impact do you see on your business due to ongoing Iran war and supply constraints? Any impact on rate of interest or increase in project capex module costs due to FX movement?
We are not yet seeing any material adverse movements in terms of either availability of equipment or in terms of material movement in capital costs. Right? This is what I would say. So we are not yet seeing any material movements which could be attributed to the war in Iran and so on. That said, of course, it's a volatile situation. So, with that caveat, this is what I can share.
Thank you.
Next question.
Our next question is from the line of Mohit Kumar from ICICI Securities. Please go ahead.
Hi, good afternoon, and thanks for the opportunity. My first question is, how much of your under construction capacity, which is roughly around 2.6 gigawatt, I believe, is under CTU connection? And how do you think about the curtailment for the new capacities, and does your PPA provide for any protection? Yeah.
So, Mohit, in the next year, as we had said earlier, so firstly, Mohit, welcome. Nice to have you on our call. Thank you. So as we said, we will have a minimum of 1,500 megawatt being added every year. So for FY26, 27, we've given a guidance that the company will add a minimum of 1,500 megawatt. 530 megawatt is the size of one CTU project we're adding, since your question was specifically in CTU. And this is 450 megawatt of wind and about 80 megawatt of solar in a substation called Koppal. Right? So this is in Karnataka state. So it's a dominantly wind capacity being added this year. And I think in generating profile of wind hours in South India, I think curtailment has been relatively minimal, is what I'm hearing in the industry. So we are hopeful on that. I think the curtailment issue is much more CTU and much more concentrated on Rajasthan and Gujarat. Of the remainder capacity, about a gigawatt we will add in STU, maybe more, let's see. And on those, we don't see curtailment kind of challenging. So that's part one of your question in terms of CTU capacity. And every year, the way I would say is every year we're adding about one project in CTU, which is 500 megawatt, and the remainder, which is 1 gigawatt in STU. Right? And at the start of or out of 3,100 megawatt, about 12% of our run rate EBITDA was CTU. So we have a small starting point, and therefore, honestly, compared to other players of the industry, the CTU curtailment issues are less for us, right? Because of this diversification of risk and a dominantly or 100% CNI, 88% STU or rooftop portfolio. As of 1st April 2026, these backdown issues impact us less. That's what I would say. Was there another aspect of Mohit's question?
Does your PP provide protection?
Do the PPAs provide protection for that? As in, not in the way that if the grid is curtailed, I'll still pay you, which is, I think, where your question is going. That, people, because obviously corporate customers do not have pay-for-performance contracts, and if for whatever reason, internal or external, you are unable to generate the power, they're not liable to pay.
Understood. My second question is, how do you think about the impact of the new deviation settlement mechanism? Of course, I think it's most likely to impact the C2 connected projects. But how can it impact your revenues if it goes through in current form? And what are the mitigation which are available to us?
So, Mohit, we don't have a final decision on that yet. But I'll tell you what our current state of play of thinking is and by when we expect to have a final decision. Okay? So one is, for the benefit of, again, everyone, that the DSM rules came in, I think, a few weeks ago. Because they seem quite onerous on power producers and apply really to all power producers, it's not about us, it's about the entire industry. They were promptly taken to court, and even just yesterday, the MNRE minister had a statement about constant meetings between MNRE and Ministry of Power to try to find a solution to this issue. So firstly, it is not a settled issue in itself, right? It is both sub judice as well as the government has openly said that we are trying to resolve it, and it's an industry-wide issue is one way of thinking about it. Second is, honestly, the impact is relatively recent, or the announcement is relatively recent, and therefore our own internal calculations of impact are not mature enough to share with an external investing audience yet. Right? So it's not like we're not working on it, but it's not yet mature enough where we are sure that this is the estimated impact, and it is complicated because what you will need to do, the whole industry will need to do, is improve their forecasting system. But how much improvement do we think we can bring about, right? Because we've not yet started doing it, is the assumption which we all have to work on. These kind of mechanisms exist all over the world. And in other geographies, people have invested in and improved their ability to forecast very accurately the power generation outcomes of solar and wind power plants. So, to that extent, that has to be done. Now, the big mitigation for this is, can we look at energy storage to do two things? One is to limit the downside from DSM or curtailment kind of issues. So that will limit the downside benefit of energy storage. But there's also captured value on the upside, because store daytime power and pump it into the night when the tariffs are higher. So that's the thing we are looking at. But this will also have to be blended in with our customer contracts. So we expect that in 3 or 4 months' time, we will be able to make a proper announcement to investors in terms of what we are doing, in terms of what investments we are doing in storage, and what that impact is on both DSM curtailment and revenue side. But it is, we haven't yet made a decision, right? But there is definitely work underway.
Understood, sir. Thank you and best of luck. Thank you.
Thank you, Mohit.
Our next question is from the line of Gaurav Birmiwal with Axis Mutual Fund. Please go ahead.
Hello, sir. Thank you so much for giving me this opportunity. Sir, 2 questions. One, can you throw some light on what is this cash flow hedge on which we booked a below PAT item of 414 crores of gains pre-tax? That's one. And second, can you just help me understand why do we have loss for minority interest in non-controlling interest again, when we attribute the fact between our own company and minority investors? I mean, minority interest for our SPVs.
So, I'll take both the questions. First one, there is the cash flow hedge is nothing but an accounting entry which is there against our VPPA or IREC contracts, wherein it's a contract for difference, whereas the power has to be sold on the exchange, but there is the derivative portion is paid as a contract for difference. So based on the power curve analysis and power price projections of 25 years, you have to account it. So it is a both side entry, which is it's the one side which sits particularly on this both side on the balance sheet. One sits on the your financial asset, if you see, which is on the current other financial assets, and on the liability side, it sits on the hedge reserve. So that's nothing but the accounting treatment of those kind of a contract, and it just offset each other on the balance sheet. I think your other question was why minority interests are negative. So minority interests are typically at the SPV level where the power generating assets are there, right? Where, let's say, there is a 26% off-taker, it still is a minority interest and needs to be accounted for. Given that our average age of our asset is very young, it's less than 2 years, at an asset co level, the profitability, which is profit after tax, only comes after 4th or 5th year. We've explained it also in our letters to shareholder in detail. So that's why at the asset co level, if you look at it, or the SPV level, there is a negative PAT. There is a lot of cash flows, but the PATs are negative because of the interest and the depreciation in initial years. So the minority interest at initial years are negative, and that's why it reflects as a negative on the overall portfolio. It's a function of the average age of the asset of the fleet. I hope it answers both the question, and if you have any follow-on, you can tell.
Yeah, thank you. This is very helpful. Just a small clarification on the first bit. So in a very simplistic way, let's say if the average rate of power on the exchange moves up, we'll be booking a M2M gain, which is discounted to present value terms, and hence we will book gains. And let's say in a case where the converse happens, where the power price on the exchange goes down, we'll be booking a loss. That's right?
No, there is no, just to clarify, Gaurav, there is zero P&L impact. The reason there is zero P&L impact is our tariff is a fixed and guaranteed tariff over a 25-year contract duration. Right? So again, these are balance sheet items given the nature of the contract. That's the accounting standard. So they feature on both asset and liability with zero P&L impact.
Fair enough. Understood. Thank you.
Thank you.
Thank you, Gaurav.
Our next question comes from the line of Neil Ostwal with PGIM India Asset Management. Please go ahead.
Hi, sir. Congratulations on a strong set of numbers. Out of our total contracted capacity, does any project also include BESS? And what would the C&I tariffs broadly look like for projects with BESS?
So honestly, out of 2,600 megawatt of capacity, the quantum of BESS is about 5-7 megawatt. So honestly, I don't think you could really, I would not say that tariff is inclusive in BESS contracts. These are, again, dominantly, if the scale is 2,600 megawatt and your BESS size is 5, 7, 8 megawatt, I would not then try to break up the tariff between the two.
Understood, sir. Thank you.
Thank you.
Thank you, Neil.
Our next question comes from the line of Abhi Segal with Singularity AMC. Please go ahead.
Hello, sir. Just two questions from my end. So with domestic module prices going to be elevated with ALCM now going to be coming in from June 26, how are you seeing the project IRRs evolve in the C&I segment, sir? Is the pricing pressure going to be absorbed by you guys or the customers or the module maker through higher tariffs, sir?
So the way our industry works is really we all calculate and we all IRR seekers. And historically, what we've always seen is tariffs adjust upwards or downwards to reflect changes in module prices. Right? And reasonably quickly, because it's obviously a competitive industry, so it adjusts upwards or downwards reasonably quickly to take that into account. I can say with confidence for ourselves, we've generally priced with the same target IRR in mind. And obviously, therefore, the implication is if the module cost goes up because of making cells in India, then that passes on to a customer in terms of higher tariffs. That said, I would also hasten to add that the implication is that the total savings to customers sort of falls only marginally. So if they were saving 30 to 35% on their power bill, they are now saving maybe 22 to 25%. And the range is because it varies by state, it varies by wind plus solar mix and so on. So in that range, people are still enthusiastic buyers of green power. So no impact on margins, no real impact on volumes either.
But do you see, like in terms of ordering from the CNI segment specifically with ALCM coming in, how is that playing out? Are people waiting till this actually comes in to just see how it plays, or are they already started assuming this and placing orders?
What always happens, see, as an industry, we've had 2-3 rounds of this. Earlier solar modules was 0% import duty, then we had import duty. Then they went from, you can import to now you can only do make in India, that caused the cost to go up, and now there's a third round, right? So what we've seen the last 2 cycles of this is, yes, you have accelerated buying because even customers say, if we are on the fence on a decision, which is if managerially they are sort of could do it now, could decide after 3 months, typically they'll decide very quickly because, internally the conversation will be, the cost is going to go up, so let's ensure we make a decision quickly. So I'm sure some of that will get reflected when we all discuss it end July or early August about our April to June 2026 quarter capacity addition numbers. Some of that enthusiasm of customers to have a tariff reflecting domestic modules and not domestic cells will get reflected in those capacity additions. But if those customers miss that part, they are still looking at later in the year and they are then signing contracts.
Noted, sir. Thank you so much, sir. Thank you. Congratulations once again.
Thank you.
Thanks.
Thank you. Our next question comes from the line of Atharva from Canara Bank Securities. Please go ahead.
Hello, sir. As you said, there are 42%.
Hi, Atharva.
Hello. As you said, 42% is through data centers and AI, and it's on a megawatt basis, it's a 10x growth from 240 to 2400. So do you think that data centers will be the largest incremental driver of the renewable CNI? And also you have the collaborations with Iron Mountain and STP data centers. So what does the future pipeline looks like in this particular data center sector?
So you're right, 42% share of data and AI is fairly massive. And of customer segments, we see that as a big dominant segment. And personally, I'm astounded by the kind of power consumption growth numbers they are exhibiting on the ground when they start putting in AI chips. Right. So once people start deploying the AI chips and AI compute workloads in India, and we've seen that in a few of our clients, each building which houses AI chips consumes 10 times the amount of power of the next building. So it may be the same number of buildings that a data center had, but suddenly the power consumption growth is fantastic. And, so we see a lot of continued growth from data and AI. That is true. And the advent of AI workloads beginning to move to India is a big future driver. Within that, if you see what kind of power do data centers need and where do they need it, it is dominantly today in the states of Maharashtra and Tamil Nadu. In both states, we are quite strong, right? Because the cable landing points are Mumbai and Chennai. And the second order data center states are states like Karnataka, and maybe in a couple of years, Andhra will start coming up. But we have a fair bit of capacity there. So, we are quite well positioned to continue a strong performance from our side in the data and AI space. And these are in the nature of strategic partnerships with customers owning 26% equity. because even the data center operator knows that their clean energy partner has to invest hundreds of crores to ensure that the data center has cheaper, greener power, right? So it's a strategic collaboration, a tier one partnership, so to speak, rather than just an also-ran vendor, right? So that's why it's a CEO level decision on both sides. So we're very confident that we will be able to continue our leadership in this data and AI segment. And this is not just with India-based data centers, this is also with global big tech. So if you just run a public search on on big tech who have talked about the work, they have talked about the work they're doing with us. The names include the likes of Apple, Meta, Google, and Amazon. So we are not just very well entrenched with the data centers in India, but also with the global big tech, who are obviously very big players globally in the AI landscape.
Okay. Thanks. Thank you so much.
Thank you. Our next question is a text question from Nupa Dadu from Swan Investments. What is the reason behind the lower EBITDA margin on RE sales portfolios compared to utility scale players who post 89 to 91% of margin? Is there any specific costs which C&I players have to incur as compared to utility scale players?
Yeah. So you're right. At a gross margin level, our gross margins is quite similar. Gross margins is around 92.5%, 93% for a wind plus solar portfolio. Most players would have a similar gross margin. If it's pure solar, it may be a slightly higher gross margin portfolio for other players. But why is our EBITDA margin at about 83%, slightly more than the EBITDA margin of other players? It's two factors. One is scale, and the second is generally higher operating cost of selling and building at 13 megawatt at a time. Right? So let me explain this. So first, in terms of scale, in terms of our EBITDA numbers, I think compared to some of the larger listed players, they are much larger than us. So there's natural operating leverage. But at the same time, there's some genuinely higher costs because we have to have a large business development organization and capability, multiple offices, projects across multiple states, 13 megawatt PPA size. So, that also creates certain overhead burdens. So naturally speaking, even with scale, I would think that our EBITDA margin would be slightly lower. We believe, and I can even say we would be confident in saying that 3 to 4 years out, this EBITDA margin goes from about 83% today on RE power sales to nearly 86%, give or take a little bit. So, there will be some rise, but we may still be a couple of percentage points at scale. We may still remain a couple of percentage points below very large pure utility players.
Thank you.
And
our next question.
I would hasten to add, though, if I may just add a last point, that 2 to 3% of EBITDA margin that you sacrifice in slightly higher operating costs is more than made up in a fantastic tariff you get in this business model. As we saw, our weighted average tariff of 2.6 gigawatt, which is under construction, was about 3.8 rupees. So, you more than make it up there, and that creates a high ROI and cash ROE for us compared to utility players.
Thank you. Our next question is from Puneet Gulati. Please accept the prompt on your screen, unmute your audio, and proceed with your question.
Yeah, thank you so much. Congrats on good performance. My first question is on your interest cost. Do you see room for further reduction in interest cost from where you are?
Thanks, Puneet. Good to see you again on this call. Interest rate cost, Puneet, is a tricky number to give a prediction on right now, because yes, we do see some potential upside, which is lowering of interest rate, due to company-specific and performance factors. What are these? These are in the likes of, we have a new set of projects to refinance. The cost on that should come down. And our detailed numbers give the breakup that under construction projects have a higher interest rate compared to fully built projects. So we see some potential benefit there. So that effort on refinancing and lowering interest costs is always on, and that's company specific. But we are also in a macro environment, I think we would all recognize, of uncertainty and potentially rising interest rates, given the global and India macroeconomic environment, including on our FX rates, interest costs, and so on. So we are not very sure how these internal ability to reduce it will balance with the macro factor of increasing, and therefore, given that uncertainty, we would hesitate to make any bold bets on what we can achieve.
Okay, understand. On your 525 CTU project, while you talked about, curtailment and difficult to predict what sort of curtailment, what are you experiencing in last 1.5, 2 months?
In that, about 30% in that substation, the curtailment number is about 30% today, Puneet. There's a substation
30% of power produced.
Yes, power injected, 30% of that is being curtailed in Bikaner too. That is the, and it's not just our number. We know the number for the substation, and everyone else in it.
Right. And when is the full, substation likely to come here? Any update on the timeline?
The grid has forecasted the end of backdown by September of this year. But it's their number. Please do not take it as a company number. I would say it's a unknown. It's an externality beyond our control. And I would, to answer your question, I'm saying that yes, grid has forecasted September, but I would also hasten to add, for the benefit of everyone else, that this is a very tough thing to do. They're building very large power transmission networks, and उसमें naturally speaking delay होता है. So, I would urge everyone to be more conservative than what the grid has officially stated.
Understood. That's helpful. And lastly, on your new PPA with Apple, 150 megawatt, 104 crore of investment.
It's not a PPA, Puneet. It's a joint venture. It's a co-investment. It's not a PPA.
Yeah. So for this co-investment, what sort of multiple have they come in? If you can talk a bit about that.
Puneet, we are bound to disclose only as much as is there in our press release. So bear with us on that.
Sure. Understood. And lastly, what sort of, solar module prices are you seeing for the contracts which you will be commissioning post June 2026?
So we've not yet started buying for that, Puneet.
Okay.
Because the reality is what has been the consistent prior experience in these shifts from importing to ALM era has been till the effective date of transition. You don't know if you're going to transition or if you're going to have an extension, right? So this is the reality. And therefore, everyone's sort of waiting that we will see what happens, and we're all aware of the fair points on both sides of the argument of whether to immediately implement it or to give it some breather and some time extension. But till the government does not make a decision, we're not really contracting actively for that.
Understood. And does that not create any risk of project delays for which there could be liability, or that's already discussed with the customer?
So it's already done and dusted from that perspective, Puneet. As I explained earlier, the natural buyer behavior is those who a couple of quarters ago were on the fence in terms of their business decision, made a decision rather quickly saying, Jaldi se laga lo because it'll be cheaper. So we're going to have high amounts of volumes in this quarter. And the way we also, having seen this whole story pan out before planned it, is that we don't have much solar commissioning in the July to September quarter. We said, look, let's keep that quarter light on commissioning. Right? Okay. Anyway, it's rainy season. It's not that easy to build. There'll be some amount of wind commissioning there. And we will start building solar again, taking module deliveries really from September or October. So that's how we also planned it, given we've seen this play out before and we know the uncertainty it comes.
Understood. That's very helpful. Thank you so much and all the best.
Thank you, Puneet.
Thank you. Our next question comes from the line of Atul Tiwari from JP Morgan. Please go ahead.
Yes, thanks for the opportunity. So my question is on the pipeline that is building for new contracts for FY27. So you have signed new contracts with 1,400 megawatts. So how is the pipeline shaping up for FY27, and also will it have the same skew towards data center and AI at say 40 to 45%?
So, hi Atul, and thanks for the question. So if we think about what we are adding as a company in FY26-27, the current fiscal, capacity that we will add is already contracted. So at the start of the fiscal, we have 2,700 megawatt contracted yet to be built. Or was it 2,600? 2,600, not 700. 2,600 megawatt contracted yet to be built. And we gave a guidance saying at least 1,500 megawatt we will build this year. Right? So at the start of the fiscal, 100% of the capacity expected to come up this year is already contracted. That's point number one. Point number two is sort of how are you faring as a company on renewing your pipeline, because obviously you've contracted something which you will build again, but you have to keep renewing that so that you also take care of future growth. So if you look at the last financial year, FY25-26, we had those numbers earlier, Atul, that we built or commissioned about 1,400 megawatt of energy sale contracts. We also had new contracting of 1,400 megawatts. So in that sense, you could say that, there is an order book, if you will, or a pipeline, and from that you build, but you also have to refresh or renew it. And we do think that from what we are seeing, it's not a projection, guys, but from what we are seeing, we don't see any real reason for either the mix of wind and solar or the share of data and AI within this pipeline to change. We don't see that, right, as of now. Of course, we are not solving for a particular percentage. We are trying to sell to everyone, so let's see in the end where we get to. But if you just look at the last financial year, even at the start of the fiscal, 42% of contracted capacity was data and AI, and at the end of the fiscal also 42% was data and AI.
Okay, sir. And so my second question is on, the organization's capability to commission projects. So obviously FY26 was a great year. You ended up commissioning 1.7 gigawatt, which obviously all of us realize is on par or even higher than some of the much larger and well-established and older electric utilities and IPPs. So congratulations on that. But how repeatable this performance is, going ahead? And can you ramp it up even further to, say, 2 gigawatt or 2.5 gigawatt? I'm not asking about guidance for 1 year's commissioning, but just in terms of organization's capabilities and availability of resources like land and connectivity, etc.
I think it's an excellent question, Atul, and deserves a very fair and transparent response. So I would say that, while we had a 1,400 megawatts commissioned last year in our energy sales business. Well before that, so about 2 years ago, we started saying and thinking internally that, look, we are seeing a lot of growth. So let's make the right investments in both teams, what you call organizational capability, as well as project development investments, which is really land and evacuation, to be able to capture this growth. So that journey, which really started maybe in, sometime in Jan or Feb 2024, we started saying it, with a lead time. Last year, we were able to start commissioning that, which effort started 2 years ago. The point of the effort was not we have to do it one time, we have to do it on a sustainable basis. And therefore, if you see, Atul, even in our annexure, we show in each state, we have a lot of brownfield capacity expansion, which makes it easier to expand. And that's how we have planned our growth. We have a number of super sites, which we keep expanding in states like Maharashtra, Karnataka, and so on. And we try to build our state level sites as large as possible. So yes, honestly, when we were doing 500 megawatt every year and thought about doing 1,500 megawatt every year, it felt like a real stretch, right? But I'm hopeful that the number will grow over time. But again, that is not something which we are either projecting or forecasting right now.
Great, sir. Thanks, sir.
Thank you. Our next question is a text question from Keshav Agarwal from Canara Robeco Mutual Fund. If you could help us understand VPPA, environment attributes, purchases agreements, and contract for different contracts. How do we see this being a growth driver for the company, given that 2.4 gigawatts of the capacity is towards data center and AI business? Are the contract economics any different under a VPPA versus supply power? And we have a follow-up question after that, sir.
Thank you, Keshav, for joining and asking. So firstly, let me dimension what is the size of our contract for difference business, and then I'll also explain what it is. So out of the 5,700 megawatt of contracted capacity, about 1,600, 1,700 megawatts, something in that range, is the size of our CFD business, right? So this is one dimension, right? So it's not small, but it's not a huge size. Almost all of this capacity is what is called a contract for difference. Let me explain what that is. A contract for difference basically means that that your customer, like a global big tech, is not actually off-taking the power, but buying the green attribute from that renewable energy power plant. But why is it called a contract for difference? Because they are contracting to pay you the difference between assured tariffs that they assure you in the contract and the realized tariffs that you're realizing on the energy exchange by selling your power as brown power on the IEX, right? So commercially, what it implies for us is whatever is the contracted value, let's say it is 3.4 rupees. I'm making up this number. Suppose it's rupees 3.4. Whatever is the value, 3.4 rupees we should get and we will get. But it comes to us in two parts. One, we sell the power as we produce it on the energy exchange. Let's assume we got 2 rupees for that power. Then we get 1.4 rupees as the contract for difference. Our revenue at the end of the month is both what we got for the power on exchange as well as what we got for the environmental attribute. In my example, if that 2 rupees on the exchange became 3 rupees, we will get 40 paise. So our revenue is the same, 3.4. If we got 5 rupees, we have to give them 1.6. So again, our revenue is the same, which is 3.4. right? So that's why it's called a contract for difference. I know it sounds like a novelty, but it's a very common contracting type all over the world. And even now, I think SECI recently came out with some thoughts on they will start doing contract for differences for some other purpose. So, this is a very common contracting structure. So it's all contract for difference. So we are not really taking a merchant price exposure is what I would like to highlight. We have a firm price and it's on about 1.7, 1.8 gigawatt out of 5.7 gigawatt. Right? So that's what we would like to explain, but we'd also suggest that we could catch up with you at your Balatia office and, the team could go through with this in more detail if there are further follow-on questions from your end.
Thank you. We will move to our next questioner in the queue. The next question comes from the line of Vishal Periwal from PL Capital. Please go ahead.
Yeah, so thanks for the opportunity. Yeah. So my question is, I think if I have missed this number, you did mention at a Bikaner the curtailment is 30-odd%. At a company level, this number could be how much? And second, parallel to this is when we give a run rate EBITDA of 1870 crore, so does this factor curtailment or doesn't factor curtailment?
So, two answers to your question. At a company level, in the last fiscal year, we had no curtailment because if you see this number here, FY26, our grid uptime was 99.24%, so indicating no curtailment. Right? This was for FY26. Right? Just around that cusp of that fiscal, we commissioned our plant in Bikaner, and I cannot give you specific to us, but that substation has roughly 30% curtailment. Again, it's not a projection, but it's a fact we know. The other aspect of your question was what?
The run rate EBITDA is adjusted for...
So the run rate EBITDA is not adjusted for curtailment. So 1870 crores is the run rate EBITDA, which is not adjusted for curtailment. It has, when you calculate estimated generation, there is always up to 1 or I think 1.5% grid downtime that is assumed in your estimate of power output, which is not what you guys would describe as the active curtailment which is happening nowadays. It is really what you would expect as par for course grid downtime for standard maintenance and any technical issues they may periodically face.
Okay. Got it. And one parallel to this is when you do 1870 crore EBITDA and then almost 3 gigawatt kind of capacity. So this works out to be 60 lakh per megawatt sort of run rate at EBITDA level. So I think though at a data centers and then we have a good spread over the customers that we get. So at a EBITDA level, the numbers looks like, it is similar to what the utility other players get in the market. Though we may get a better spread, but eventually at a EBITDA it is largely similar or maybe in that range. That's fair to understand, right?
No, that is not true. We are giving you a DC number. So our megawatt is on DC basis. Someone else may be calculating it on AC basis. So please adjust it for that. You will find that on a per megawatt basis, we would be, I think, 30 to 35% superior on a EBITDA per megawatt basis.
Okay. Got it, sir. And thank you very much for the answer, sir. Thank you.
Thank you. Our next question comes from the line of Mahesh Patil with ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity, sir. My question is on the PPA. So the new PPAs that were signed, right? For example, the 1.5 gigawatt that we have done in FY26. What kind of PPA or the contract timelines are we getting for the entire portfolio? It's 23 years. So have you seen any change over the last few years for the PPA or the contract timeline?
We largely, thank you for your question. We've largely seen this to be a very stable number. So we've always contracted ultra long-term PPAs with our corporate customers. So we've not seen much, any material movement in this tenor duration of PPA contract.
And sir, second related question is on the lock-in period under the PPA.
So for instance, you can later refer to page 28 of the presentation we've put out. This year, the average PPA tenure is 23.17 years. Last year, which is 2025, the number was 22.73 years. The year prior to that, it was 21.54 years. So it's really, I would not even try to say it's a improvement. It sounds like 21.54 became 23, but it's ultra long term. 20 plus years, like 22 or 23 is very similar.
Okay, got it. So the second related question is on the lock-in period, right, under this PPA. So would we have a number in terms of what is the average lock-in period? I understand it can vary from 10 years to 20 years for C&I. And
it was in our DRHP as well. You're right, I understand the question. So if you look at our DRHP as well, which is of course updated as of March 2026, we would have a average lock-in period of I think 17.85 years. Let's say 18 years. So contract tenure 23 years, lock-in duration 18 years.
Okay. And so there is some compensation clause as well, right? Penalty clause in the PPAs for in case of early termination. So that way we are secured, let's say even for a minimal percentage of our capacity if it happens. That way we are getting compensated, right?
I mean, obviously every contract has certain different types of contract performance dimensions linked to that, compensation dimensions either by power producer or power consumer. But suffice to say, the good news is we have more than 1,100 contracts. I forget the number. It's a huge number, more than 1,100 contracts, and we don't have a single ongoing client dispute. And the second thing I would say is that the diversity of clients and contract size is also an inherent risk mitigation. Right? So yes, could you argue that there could be a issue with any client? You could, but it's limited to average PPA size is 13 megawatt per client and portfolio is 3,100 megawatts. And in so many years of business, we don't have a single client dispute.
Okay. Thank you and all the very best.
Thank you.
Thank you.
Our next question comes from the line of Shaunak Godbole with SBI Life Insurance Company Limited. Please go ahead.
Hello, sir. Hi. Congratulations on a great set of numbers. Am I audible?
You are audible, sir. You may proceed.
Yes, of course, Shaunak, you are. How are you?
I'm fine. So, sir, just wanted to understand about the contracted capacity of 2.6 gigawatts. What you discussed is of the next year capacity addition, 1.5 gigawatt, which is PPA tied up. So what's the update on the balance 1.2 gigawatts of the capacity out of that 2.6 contracted? Because when I'm looking at the slide number 7 in the presentation, it is given the capacity for which either PPA or LOI has been signed. So what's the update on the balance capacity?
So if we have 2,600 megawatts at the start of the fiscal, which is contracted with customers, obviously a set of that would come within this fiscal, FY26-27, and our guidance there is minimum 1,500. We'll try to do more, and the remaining will come in the next fiscal. That's how you should think about it.
Okay. Yeah. Thanks.
Thank you. Ladies and gentlemen, we will now take our last question, which will be from the line of Jayesh Shah from OHM Portfolio Equi Research. Please go ahead.
Hello. Hi. Thanks for the opportunity. I had a very basic question. I see your cash ROIC and reported ROIC in the range of 8 to 12%, which is roughly in line with your interest cost on projects. So I was wondering, how do I look at operational IRRs and what is the value chain? What do you keep and how much you pass on to the customers, your clients, as unit economics? I'm sorry, I've just recently started covering the stock, so maybe my question is very basic. Thanks.
Yeah. So, cash ROIC, we see in our shareholder letter, our cash ROIC is about 14%. So I was a little alarmed when you gave single-digit numbers. So I wanted to ensure that we have the same set of numbers. So on page 11 of our shareholder letter, it shows our 3-year average cash ROIC, being about 13.75% in the previous fiscal. In the last fiscal, it's around 13%. And cash ROE, return on equity, was 16.81% in FY24-25, has risen to about 17.42% in FY25-26. Right, so those are the precise numbers. So let's say about 13% for cash ROIC and about 17% for cash ROE. And so that's just in terms of the number itself. But, I would also encourage you, Jayesh, if you've just started covering, why don't we have you over at our office and explain the business in more detail, because it'll be tough to really go through the nuances of how to think and look at ROI and ROE in our business, particularly because we have a lot of projects under construction as well.
Sure. Appreciate that. Thank you. I'll get in touch.
Yeah. All right. Thank you.
Thank you. I would now like to hand the conference over to the management for closing comments. Over to you, gentlemen.
Thank you very much, everyone. We are constantly trying to learn. This was our second earnings call. We felt more comfortable than our first earnings call. We would also just encourage you all to reach out directly to us and or our IR team. Nikhil, you'd like to introduce?
Yeah, sure. We have Rahul Mistry just joined us yesterday as our head of IR. He's also on the call, and I'll just request Rahul to say hi to everyone, and he would be reachable to all the shareholders as well for any first level of questions, meeting, clarification.
Hi. Thank you, Nikhil. Thank you, Kuldeep. I'm looking forward to interact with all of you individually and welcome you all to any questions that you guys may have. Happy to help.
Thank you, Rahul.
Thank you.
We want to introduce you all to Rahul. He's new to our team, but I'm sure not new to many of you. You all know he came from JSW Energy, so he may know some of you from that time. Please do reach out to us. We'd be delighted to continue meeting and interacting with all of you.
Thank you. Thank you. On behalf of CleanMax, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.